This is a developing story from global financial markets, where a sharp and unexpected decline in precious metals prices is unfolding against the backdrop of a major energy shock and rising geopolitical tensions. Gold and silver, traditionally viewed as safe haven assets during times of uncertainty, are both moving downward even as broader conditions would typically support gains. This unusual pattern has raised widespread questions among market participants and observers about whether the underlying dynamics of these assets have fundamentally changed or whether other forces are at play. At the center of this development is a rapid and historic surge in energy prices. Dubai crude oil, which serves as a key benchmark for physical oil in the Middle East, has risen dramatically to $170 per barrel. This represents a significant increase from $65 just 3 weeks earlier, marking a sharp escalation within a very short time frame. The speed and magnitude of this rise distinguish it from previous oil crises, where price increases occurred over longer periods. This sudden escalation is now being described as an oil shock rather than a gradual market adjustment. The implications of this surge extend far beyond the energy sector. Oil is a foundational input for a wide range of industries, influencing transportation, manufacturing, and supply chains across the global economy. As oil prices climb, costs increase across multiple sectors. Fuel prices are rising, transportation expenses are increasing, and production costs for goods are climbing. These changes are contributing to broader inflationary pressures that were already present in the global economy. At the same time, central bank policy is playing a significant role in shaping market reactions. The Federal Open Market Committee has chosen to maintain interest rates within the range of 3.5 to 3.75%. While rates were not increased, expectations for future rate cuts have been reduced. Projections that previously suggested 3 rate cuts in 2026 have now been adjusted to indicate only 1 potential cut, possibly later in the year. This shift has reinforced the expectation of higher interest rates for a longer period. Higher interest rates have a direct impact on investment decisions. When government bonds offer yields above 4%, they become more attractive relative to assets like gold, which do not generate income. As a result, institutional investors may shift capital toward yield-bearing assets. This movement can place downward pressure on gold prices, even in an environment where inflation and geopolitical risks would typically support demand for safe haven assets. However, the current situation is not being driven solely by interest rate expectations. Market activity indicates that liquidity pressures are playing a major role. As oil prices surged, positions held by investors who were betting against energy markets experienced significant losses. These losses triggered margin calls, requiring immediate access to cash. In such situations, investors often sell assets that can be quickly converted into cash, regardless of their long-term outlook. Gold and silver are among the most liquid assets in global markets. They are traded continuously across multiple time zones and currencies, making them accessible sources of immediate liquidity. As a result, they have been sold in large volumes to meet margin requirements. This selling pressure has contributed to the decline in prices, even though the broader economic environment might suggest the opposite direction. The situation has been further intensified by changes in trading requirements. The Chicago Mercantile Exchange increased margin requirements for both gold and silver during the period of market stress. Gold margin requirements rose from 6% to 8%, while silver margins increased from 11% to 15%. These adjustments required traders to provide additional capital to maintain their positions. For many participants, especially those using leverage, this created additional pressure to liquidate holdings. The result has been a cascading effect, often referred to as a margin call spiral. As prices fall, more margin calls are triggered. This leads to further selling, which in turn drives prices lower, creating a self-reinforcing cycle. This process can continue until the selling pressure subsides and the market stabilizes. At the same time, developments in the physical market for precious metals are adding another layer of complexity. The infrastructure used to store and deliver physical silver is under strain. A significant portion of approved storage facilities for futures contracts is concentrated within a relatively small geographic area. During periods of high demand and volatility, this concentration can create bottlenecks in the delivery process. In response to these concerns, legislation has been introduced in the United States aimed at expanding and strengthening the network of licensed storage facilities. The proposed measure focuses on increasing the capacity and resilience of the system used to handle physical metal deliveries. This move reflects concerns about the ability of existing infrastructure to manage current levels of demand and volatility. Meanwhile, international developments are also influencing the market. China, a major participant in the global silver market, is increasing its acquisition of physical silver. This activity is occurring ahead of a policy change scheduled for April 1st, when export tax rebates for refined silver are set to expire. The change is expected to reduce the incentive for exporting silver, potentially limiting the supply available to global markets. As a result, while the paper price of silver is declining due to market mechanics and liquidity pressures, physical demand is increasing in certain regions. This divergence between paper and physical markets is becoming more pronounced, raising questions about how these dynamics may evolve in the coming weeks. Taken together, these developments present a complex picture. The decline in gold and silver prices is occurring alongside rising energy costs, persistent inflation, shifting monetary policy, and structural challenges in physical supply chains. Each of these factors is contributing to the current market environment, creating conditions that differ from traditional expectations. As the situation continues to unfold, attention is turning to how these interconnected forces will shape the next phase of market activity. The interaction between energy prices, monetary policy, liquidity conditions, and physical supply dynamics remains central to understanding the current landscape. As the situation continues to develop, a closer examination of the sequence behind the market decline reveals how rapidly conditions escalated once the initial shock took hold. The surge in oil prices to $170 per barrel acted as the starting point of a chain reaction that moved across multiple asset classes. Investors who had positioned themselves against rising energy prices, particularly through short positions, faced immediate and substantial losses as prices climbed sharply within a compressed time frame. These losses did not remain isolated within the energy sector. Instead, they triggered a broader liquidity event that spread across financial markets. When losses reach a certain threshold, financial institutions and traders are required to meet margin calls. These calls demand that additional capital be deposited to maintain open positions. The urgency of such requirements leaves little room for strategic decision-making. Investors must raise cash quickly, often within hours. In these circumstances, the priority shifts from long-term asset allocation to immediate liquidity. The focus becomes identifying which holdings can be sold rapidly and in sufficient volume to meet obligations. This is where gold and silver entered the equation. Both metals are among the most liquid assets in global markets. They are traded continuously with deep markets that allow for large transactions without significant delays. Because of this liquidity, they are frequently used as a source of funds during periods of financial stress. As margin calls intensified following the energy market losses, institutions turned to their holdings in precious metals as a primary source of cash. Large-scale selling began, not as a reflection of changing views on the value of gold or silver, but as a direct response to liquidity needs. This initial wave of selling set off a broader cascade. As prices began to decline, additional margin calls were triggered across other leveraged positions. This created a feedback loop. Falling prices led to more margin calls, which in turn led to further selling. The process became self-reinforcing, driven by automated systems and risk management protocols that operate independently of broader market sentiment. In such an environment, price movements are dictated less by fundamentals and more by the mechanics of liquidation. The role of exchanges in this process also became significant. The Chicago Mercantile Exchange increased margin requirements for both gold and silver during the period of heightened volatility. For gold, the margin requirement was raised from 6% to 8%. For silver, it increased from 11% to 15%. These adjustments are designed to manage risk within the system, ensuring that participants have sufficient capital to support their positions. However, when implemented during a period of stress, they can intensify selling pressure. Traders who were already facing margin calls suddenly found that the capital required to maintain their positions had increased further. For those operating with leverage, this created an additional burden. Many were unable to meet the new requirements and were forced to liquidate their holdings. This contributed to a second wave of selling, adding momentum to the downward movement in prices. The combined effect of initial margin calls and subsequent margin increases created what is commonly described as a margin call spiral. Retail investors were also affected by these developments. Leveraged exchange-traded funds tied to silver experienced exceptionally high trading volumes during this period. The increased margin requirements and rapid price declines created conditions that many individual investors were not prepared to manage. As a result, forced liquidations occurred across a wide range of accounts. These actions were not necessarily driven by changes in long-term outlooks, but by the structural requirements of leveraged trading. While these financial mechanisms were unfolding, developments in the physical market continued to present a different picture. The infrastructure supporting the delivery of physical silver became a point of concern. Most approved storage facilities for silver futures contracts are located within a limited geographic area, primarily near New York. Under normal conditions, this concentration allows for efficient management and oversight. However, during periods of high demand and volatility, it can create significant logistical challenges. As more participants sought physical delivery of silver, the system began to experience strain. The movement of physical metal requires transportation, processing, and documentation. When demand increases sharply, these processes can become bottlenecks. Reports of exchange halts and delays in delivery processes highlighted the limitations of the existing infrastructure. These disruptions indicated that the system was operating near its capacity limits. In response to these concerns, legislative action was introduced in the United States. The System Integrity through Licensed Vault Expansion and Resilience Act, referred to as the Silver Act, was proposed to address vulnerabilities in the storage and delivery system. The legislation focuses on expanding the network of approved vaults and improving the resilience of the infrastructure. The timing of this proposal, coinciding with market volatility, underscores the level of concern among policymakers regarding the stability of the system. The introduction of such legislation suggests that the challenges in the physical market are being recognized at an institutional level. It reflects an understanding that the ability to convert paper contracts into physical metal is a critical component of market integrity. Any disruption in this process has the potential to affect confidence in the system as a whole. At the same time, international activity continued to shape supply dynamics. China's actions in the silver market became increasingly significant. As the April 1st deadline for changes to export tax rebates approaches, Chinese entities have accelerated their acquisition of physical silver. This activity is driven by the expectation that exporting silver will become more expensive after the policy change, reducing incentives to supply global markets. The result is a shift in the flow of physical silver. Instead of moving toward international markets, more of the metal is being retained within China. This reduces the availability of supply for other regions, particularly those that rely on imports to meet industrial and investment demand. The timing of this shift, occurring alongside increased demand and infrastructure constraints, adds further complexity to the market environment. What emerges from this sequence is a clear distinction between the behavior of financial markets and the conditions in the physical market. On one side, prices are being driven lower by liquidity pressures and margin-related selling. On the other, demand for physical metal remains strong, and supply is becoming more constrained. This divergence is a key feature of the current situation and plays an important role in understanding the broader context. As these factors continue to interact, the market remains in a state of adjustment. The immediate effects of margin calls and forced selling are still being absorbed, while structural issues in the physical market are gaining attention. The combination of financial stress, policy responses, and shifting supply patterns is shaping a complex and evolving landscape.